Hey, Brandon, have you seen Alan?
Can't find him.
Oh, I hope he shows up. I saw him looking at a bunch of books at the last minute. I'm not sure what's going on.
Yeah, hopefully he'll be here in 2 minutes.
Yeah, we're going to start in 2 minutes. But first, let's tell a joke, all right? So a pirate walks into a bar, and the bartender says, "Oh my gosh, pirate, it's been only 6 weeks. You're back here. No eye, no hand, and no foot. What on earth happened to you?" "Wow," the pirate said, "I was in a pirate ball fight, and I should have stayed behind the covers. Instead, a cannonball came and took my foot off. It was horrific, and now I have my peg leg, and I don't have to do as much work on the boat." So then the bartender says, "Well, what happened to your hand?" "Well," I said, "I was defending the honor of a lady in a sword fight after drinking rum, and the next thing I knew, I just had to hand it to him. My hand was gone. Now I have this hook." In the real joke, he had a hook. "So, no one on the boat messes with me, and I only help with the navigation now." "Well," the bartender says, "how'd you lose your eye?" "Well, one morning, a beautiful morning, as the sun was coming up, I looked up to navigate. I could still see the stars, and a bird pooed in my eye." And the bartender said, "A bird pooed in your eye, and you lost your eye?" "Aye, it was the day after I got my hook." Well, I hope everyone enjoyed that joke. And speaking of jokes, Alan will come on soon, and we will cover what the Biden tax plan means for estate planning and more estate tax planning strategies. So I'm going to look at you. That's a pretty interesting bunch there. Ooh, there's somebody very attractive. All right, 3, 2, 1. Hello, everybody. I hope you've enjoyed the best part of the webinar. The mediocre part is now. I'm Alan Gassman, hiding behind a mustache because we've been in isolation so long. And this is Brandon Ketron. We are in Clearwater, Florida, and we are estate tax planners. We used to be PPP lawyers for a while, but now we're estate tax planners. And we're going to talk about what the Biden tax planning means for estate planning. We have been giving this as a long series. Many people have endured what we've done so far. Hope you enjoy this. We are watching your questions, watching your emails. You've got our email addresses there. We will answer questions to the best of our ability. And if we can't answer them, he will. There is no continuing education credit being given for this program. We just want to be able to talk and tell you what we need to talk about. About 1 hour after we close off this program, you will get an email from GoToWebinar, and it will have the slides and a link that you can click to in case you want to watch this over and over and over again. You'll be able to do that at no charge. Wednesday, June 16th, my partner, Christopher Denicolo, and I will be speaking at the 37th Annual Bankruptcy Restructuring Conference. It's a virtual series. We'll be talking on tax planning for troubled companies. If anyone would like to see the replay or would like to attend the program, please just let us know, and we'll encourage you to do that. On Wednesday, June 16th, a free webinar with my friend, Professor Jerry Hesh and Luz Randolph. We're going to talk about life insurance planning, and anyone who knows Professor Hesh knows that that will be both entertaining and very enlightening. So, as we know, there is an $11,700,000 estate tax exemption held by most Americans, and it goes down when you make gifts exceeding $15,000 per person per year. When you die, that exemption can be put to great use going into a credit shelter trust, also known as a family trust, also known as a bypass trust, which can benefit your surviving spouse, giving the spouse what the spouse reasonably needs for health, education, maintenance, and support. And then when the spouse dies, the spouse can direct where the trust assets go based upon whatever parameters you've laid out. And if properly configured, if properly formed, if properly managed, whatever that 11,700,000 grows to will not be subject to federal estate tax. If you don't use the whole 11,700,000 on the first death, there's something called portability that allows your surviving spouse to use what you did not use. But unlike a credit shelter trust, which should grow very quickly and over time, the portability allowance does not grow, and it can disappear if your spouse remarries. To the left, an irrevocable life insurance trust. This can own life insurance on one or both spouses. If it's on one spouse, then it can benefit the surviving spouse to take the life insurance completely out of the estate tax system. There was a case that came out last week which will impact how life insurances or trusts are used with reference to split dollar. The case is called Morissette 2. It's kind of like Son of Frankenstein because there was a Morissette 1. Quite often, Brandon and I will set up an irrevocable life insurance trust for a client, but not have the client pay premiums on the policy. We'll have loans made to the irrevocable life insurance trust, and the loans are made using a somewhat fancy word, split dollar loan. So instead of me paying $100,000 a year of premium and using $100,000 a year of my allowance or my gifting ability, I can have my family LLC simply advance $100,000 a year to the life insurance trust, and when the insured dies, the first money back comes back into the family LLC. So the Morissette family did something very, very interesting. Mrs. Morissette's 3 sons needed life insurance to fund a buy-sell agreement between themselves. So she put up about $30 million in money in split dollar advances. And the deal was that when the sons died, she would get her $30 million back. And that's about it. Well, she died before the sons. The sons had 30 and 40-year life expectancies. Her estate went to an appraiser, and the appraiser said, yeah, you're owed 30 million, but you may not get it for 30 to 40 years. This is worth $7,500,000. So she filed an estate tax return showing a $7,500,000 asset. Now, somewhat unfortunately, a couple of years after she died, they forgave the loans. They took the loans that were owed to her revocable trust and just gave that right to each of the life insurance trusts, and the loans went away. And the tax court looked at that, and the tax court looked at the whole thing, and the tax court wrote a 120-page decision. And a big theme of that decision is, in my opinion, we don't like split dollar because you can do things like this with it. So there's something called the split dollar loan regime, which seems to be fairly safe even after the Morissette opinion. And then there's something called the split dollar equity regime or endorsement regime, which we don't think is very safe anymore. So if you want more information on that, let me know. It was tangent number 1 of today's presentation. Now, taking this lovely married couple on page 9, the best thing spouse 1 can do for spouse 2, besides leave spouse 2 and let spouse 2 get a better spouse, is to reposition camera, thank you, is to make a gift. Spouse 1 can make a gift to a lifetime bypass trust, also known as a spousal limited access trust, and that trust can benefit spouse 2. She or he can receive amounts as reasonably needed for health, education, maintenance, and support. He or she can direct where the trust assets go on the second death. The assets are out of spouse 1's estate because spouse 1 doesn't own them anymore. They are out of spouse 2's estate because spouse 2 did not fund the trust and is limited as to what spouse 2 can take out. and that is the Spousal Limited Access Trust, commonly known as the SLAT, and people are doing a whole lot of them. Now, spouse 2, in our opinion, cannot safely fund a SLAT for spouse 1 because they would be reciprocal, and then creditors would be able to reach into them under the creditor law, and therefore the IRS would find that spouse 2 retained a benefit from the trust. So we would have spouse 2 make a gift to a trust for descendants. And this trust for descendants might be in a creditor protection jurisdiction and might actually allow spouse 2 to be added back as a beneficiary if spouse 2 has a horrific financial situation. We typically are funding or drafting 2 different types of slats. One type of slat, everything that's going into it has come up together during the marriage. The spouses consider these assets to be theirs. If they had a divorce, they would expect to divide them equally. That slat says that if the spouses divorce, it goes into 2 trusts. One trust continues as a slat for the spouse beneficiary, and the spouse beneficiary controls who the trustee is. The other trust is controlled by spouse number 1 and is just for the descendants, but spouse number 1 might be added in based upon the law of an asset protection jurisdiction. And if you're going to make a gift to a slat, why not set up a limited liability company and give a non-voting member interest in the limited liability company to the slat, taking a discount? I could put $5 million worth of assets in this LLC. I could keep all the voting rights. I could transfer the non-voting rights and maybe tell Uncle Sam that I made a gift worth $3,750,000 because of discounts. And of course, right now, I can pay the income tax on the income generated by this trust. What about stepped up income tax basis? How does that work? Well, today in the United States, if you die owning an appreciated asset, the asset gets a new income tax basis. So I paid $1,000 for my Tesla stock. It's now worth $1 million. I die, the basis is $1 million. My wife sells it a month later for $1,100,000. She's got a capital gain of only $100,000. Now, if I set up this defective grantor trust here and I die, is there a step up? The answer is we don't know. We hope there is. There's good lawyers and writers who say there is. There's good lawyers and writers who say there isn't. Most people want to avoid a 40% estate tax, recognizing that when their children eventually sell these assets, there may be a 20% capital gains tax farther up the road. But of course, you don't always have to pay capital gains tax when you sell something. For example, if you sell investment or business real estate and you reinvest the gross proceeds of the sale within 180 days, you can do what's called a 1031 exchange and not worry about paying capital gains, then wait till you die and you get a step up in basis. I'm mentioning this as a warm-up because Brandon's going to take what I'm saying and he's going to show you what certain senators and a certain presidential candidate might do to all of these rules. But if you are watching this webinar, which I guess is a contradiction of terms, if you're not, well, if you're listening to it or you're watching it, and you're wealthy, then our favorite strategy is put everything you can into LLCs and limited partnerships, keep the 1% voting interest, sell the 99% non-voting interest for a long-term note, 2% interest, so that everything in the future that goes up in value is out of your estate, and you're going to pay the income tax on the income of that mechanism. And there's a lot of other things you can do, and trusts that you can modify, and qualified personal residence trusts, and irrevocable life insurance trusts, and grantor retained annuity trusts, but you're already asleep even listening to the list of what those items are. So Brandon, tell us what we might expect to change and anything else you like.
Yeah, so as of right now, there's really 3, I guess, separate proposals out there. And, I'll mention off the bat, these are all just proposals. Nothing is law yet. These could go into effect as is. They could be negotiated. They could not go into effect at all. We have no clue what's going to happen here. But just to touch base on what they all say, so if they do come into effect, there's planning we can do to set ourselves up to try to decrease the consequences in a way. So the big one out there as of right now is the Bernie Sanders proposed bill on the estate tax changes. It's called the 99.5% Act. That will reduce the estate tax exemption down to $3.5 million per person, so $7 million per married couple. The current level right now is a little over 23 million, so I think 23.4 million as of today. And so you can see that's going to drastically reduce that estate tax exemption. Now, the Bernie Sanders bill has this effective January 1, 2022. There is a possibility that another bill proposed could be effective the day it comes out of the House and Ways and Means Committee. So we have to keep our eyes out, see when these effective dates are going to be. As of right now, there's nothing that would show it would be a retroactive in effect, but that is always a possibility. So if you are estate taxable, you want to take advantage of the increased exclusion now while you can, before a bill is proposed that might make it effective the day it was discussed in the Ways and Means Committee, and therefore retroactive in effect when it is passed. Another thing that would happen here is our lifetime gift exemption would be reduced to just $1 million. So you would get $7 million on death, but only $1 million to use during your lifetime. And the idea here was to prevent, income tax shifting by gifting assets to a lower generation that might be in a lower income tax bracket. They want to try to stop that as much as possible, so they've decreased this lifetime exclusion down to 1 million, and they're no longer tied together for life and death. The rates are going to go up a little bit, progressive in nature, depending on the level of your estate. Another thing that they're going to do with here is grantor trust, the type of trust that Alan talked about that we've used for years and years as estate planners, where the grantor can pay the income taxes on the trust. That's not a further gift to the trust, which further reduces the grantor's estate. So it works really well from an estate tax planning standpoint. You can do transactions with grantor trust without having any recognition event, because everything is disregarded for income tax purposes. It's treated as if you've sold something to yourself, so no tax consequence. Well, now if we have that type of trust and this Bernie bill passes, that type of trust will be included in your estate. So you would have to do this with non-grantor trust, which means the trust would pay its own income taxes and you would have gain and recognition events anytime you made a transfer to that trust. So that could cause some issues with a lot of the type of planning we do. Life insurance trust, the trust that Alan talked about, that's outside of, keeps life insurance outside of your estate. Those are going to be grantor trusts in most circumstances and included in your estate. Now there might be an exception for them. The life insurance lobby is very strong, so we'll just have to wait and see what happens there, but something to keep in mind. Now number 6 is important here, that if you have a grantor trust that's set up and funded before the effective date of this statute, it's going to be grandfathered. So we can do this planning now. We can sell assets to the grantor trust. The grantor can pay the income taxes. All the growth can pass estate tax free as long as we set it up before the effective date of this statute. And don't make any transfers to it afterwards, because that would impact the grandfathering status of these grantor trusts. Another thing, number 7, Alan mentioned, whether we don't know right now whether you get a step up in basis for grantor trust. Well, this act makes it clear that you do not, which is interesting that they would even say that in the statute, which leads some authority to say, well, maybe you do get a step up now for grantor trust assets on death, because if you didn't, then why would they include this provision? So that was an interesting inclusion of part of this bill. There's some changes to GRATs. Minimum terms, 25% value of the contributed property, so you can't make a transfer to a GRAT, which is a trust that pays you back an annuity over a term of years equal in value actuarially to the contributed property. And so it's another way to effectively freeze an estate and allow growth to pass estate tax free. Well, now whatever comes back to you has to be at least 25% of the value. So you're going to be making a gift to the GRAT, and there's going to be a much longer term, which increases the risk of the use of a GRAT. So they may still be effective in a way, but they're not going to be nearly as effective as they were. There's also going to be a deemed inclusion event every 50 years for estate tax purposes. So if you set up a long-term trust that's generation skipping tax free today, that trust can go for eternity without having to pay estate taxes. Well, if this passes every 50 years, there's going to be, I guess, a recognition event in a way, or a deemed termination of the trust that would cause estate taxes to apply. So you can see how difficult this can make planning in the future, and how much things would change if this does pass. There's going to be certain limitations on what we can give to a trust each year without taking into account the annual exclusion of $15,000 per donee, or sorry, per donor. Those are going to limit the way we can make contributions to the trust, particularly for life insurance trust. If you have 4 or 5 beneficiaries of the trust, you can make $15,000 contributions for each beneficiary and exclude those and not use any portion of your lifetime exclusion. Well, now if that transfers to a trust, there's going to be a $30,000 cumulative limit. So you can no longer make those large, they're called crummy withdrawal power gifts to this type of trust. Some other changes here that aren't necessarily as impactful unless particular circumstances apply, so we won't get into those. So Alan, any comments on the Bernie bill, and what are your thoughts on whether this will pass, when it might pass, and if you have any insights?
Well, I've never seen a snowball survive a desert, but there have been surprises in the legislative process in the last 6 or 7 years. I'm hoping that this will happen in a traditional manner, that we'll know in advance, or at least when it comes out of the House Ways and Means Committee. A lot of senators tend to just throw these things out so they can get publicity for them, but legislation doesn't actually start under our US Constitution until it comes out of the House Ways and Means Committee. And then quite often it says for transfers that have, or transactions that have occurred before the date it comes out of the committee, once this passes, it's going retro to that. There is case law to the effect that they could go retro to January 1st. For example, there is one provision in the Hollins rules that he's proposing, where a sale to a grantor trust would trigger income tax. And I don't think that that has any chance of passing. But your guess is as good as mine. I take people back to 2012, where the exemption was going to go from 5 million to 1 million at midnight, December 31st. Obama was the president. And instead of going back to 1 million, it went and stayed at 5 million because the Democrats traded something for it. They traded a bunch of unemployment benefits primarily for it. So this is how we also talk about hurricanes in Florida. They're like rattlesnakes. You don't know what they're going to do. I hope that wasn't a waste of everybody's 3 minutes, by the way.
Plan for the worst and hope for the best is I think the theme is.
But what's more likely though is an increase in income taxes.
Right.
Why don't you take us through what you see here from the Biden plan?
Yeah, so this is the Biden American Families Plan. There's also the Made in America tax plan and some other proposals that are just floating out there. So these are more income tax changes versus estate tax changes, and we think these are a little more likely to come into play than the all of the estate tax changes. At least there might be some of the estate tax changes come in, but as far as what's going to happen on an income tax standpoint, the top rate's going to go back to 39.6. The brackets are going to come down as far as the AGI levels of when the top rate applies. I think that that's probably pretty likely to happen here. The corporate rate proposed to go back to 28% from 21%. And then this new proposal, which is interesting, is a 15% minimum tax on book income. So basically that bottom line net income on financial statements, 15% alternative minimum tax would apply on that. Because you have corporations, I think Apple always gets bad press on this, where they have millions and millions of dollars of financial income, but their taxable income is close to nothing because of depreciation deductions and other things that can be done, offshore tax planning. So they're going to try to limit that by this alternative minimum tax. The 3.8% net investment income tax that applies now mostly just on passive type investments is proposed to apply on active business income in excess of $400,000. So if you have S corporations or partnerships that are active and you would normally not pay this 3.8% tax, now you may have to. Like-kind exchanges, as Alan mentioned, where you can sell real estate, invest the proceeds in another investment property within 180 days and defer the income tax. Now you're only going to be able to defer up to $500,000 on that 1031 like-kind exchange. So that was going to severely limit the real estate industry and how they have historically done business in the past. There's changes proposed to in preferred treatment on carried interest. There's some beneficial rules that can apply there. We won't go through those in detail, but just realize that could be changed. An interesting one here is the modification to the way employment taxes apply to, I guess, assess employment taxes on S corp distributions and income from S corporations. So right now, your S corp could earn, say, $2 million. You pay yourself a reasonable salary of, say, $250,000 a year. Well, you only have to pay employment taxes on that $250,000 because that's your salary. You can take the rest of that S corporation income as a distribution, which is not assessed employment taxes or any other taxes. Well, this proposed change would say those distributions are going to be subject to employment taxes just like your salary is. So that's going to change the planning landscape for a lot of S corporations and how they have historically avoided these employment taxes in the past. Another interesting proposal, itemized deductions, only deductible at 28%, even though the top income rate is 39.6. So they're trying to limit the ability to reduce your income by itemized deductions, which mostly impacts high earners. There's this Ps limitation that also is proposed to be reinstated. Essentially what that does in a roundabout way is just increase your marginal rate by 1.2%. It really applies by taking and decreasing your itemized deductions by 3% for every $1,000 that are over the one threshold amount. So it just drops down your deductions, but the net impact is a 1.2% increase in your tax rate. One good news for taxpayers is there's discussions of restoring the state and local tax deduction. So residents of California and New York that pay high state taxes, now they are capped at $10,000 as a deduction. There's proposals that now you can fully deduct all the state and local taxes that you pay. For us Florida residents, there's no income tax, but we do have real estate taxes that can be hit by this cap. So now those would come back in. Modifications to the phase outs for the Section 199A deduction, those would drop down. Excess business losses are limited to $500,000 currently. That's going to continue. And then these new proposals here, taxes on unrealized gains at death above $1 million. We'll get into that with the Van Hollen proposal here in a few slides, but that would be an interesting one, similar to a Canadian type system where you just tax gains on death. There's also proposals, no preferred capital gains rate for income over $1 million. So you would pay the 40% or the 39.6 rate on your capital gains if they exceeded $1 million in 1 year. Child tax credit expansion, other, the earned income tax credit, all of the refundable tax credits are going to be expanded on and extended. So essentially trying to get money to the lower income families that do need the help. Another number 16 here, increase the funding by $80 billion for the IRS. So we might be seeing a lot more audits and a lot more resources for them to come after and make sure that these rules are implemented and being divided by properly. So Alan, any thoughts on the income tax changes before we move to the STEP Act proposal and the step up in basis closing and the capital gains on debt?
Yeah, well, a lot of clients are calling and saying, what can I do in advance to prepare for these income tax changes? And quite honestly, the best answer is probably start spending less money because if you're spending all your net after-tax money now, you're not going to have any net after-tax money. And start taking tax planning more seriously. A deduction is now going to be worth 39.6% instead of 37%. And do you really need that boat to be your pleasure boat, or should you put it out for rental and write the thing off? Do you really need that vacation home to be your vacation home, or should you sell it while the market's high and the capital gains rate may only be 20%? It's a time to look at your whole situation and think through your intellectual brain and your reptile brain and see what you're keeping that you should have sold and what you sold that you should have kept, keeping in mind that your tax drain is going to be higher. Also, keep in mind that when these things happen, there will be snake and oil salespeople coming to you to give you all sorts of wonderful, interesting, complicated, and useless methods of avoiding income tax, many of them bordering on fraud or being fraud. But on the other hand, your pension plan contributions, having part of your company owned by your children and grandchildren who are in a lower bracket than you are, buying equipment that you need anyway that you can depreciate fully this year, those types of things, I would just take a little bit more time, a little bit more care. A lot of clients, quite candidly, don't have a really, really good CPA firm looking at things for them from a critical standpoint. It's probably time to do that. When things change and the boat rocks, sometimes things come loose, especially if they've been ignored. So try to keep your house and your ship in order as best you can so that you can move quickly when it's time to move.
Yep, good points, Alan. So now to just talk through here the STEPS Act and its proposals. This was Senator Van Hollen proposed this act. There's a similar proposal in the House that follows the same type of structure, with the exception that the effective date for the Senate proposal is January 1, 2020, or sorry, 2021, meaning any transaction that we did in 2021 could be subject to these rules, while the House proposal is not effective until 2022, so it would not be retroactive in effect. So what does the STEP Act do? Well, essentially, there is no longer a step up in basis for income tax purposes on death, and there's going to be a deemed realization event on your death for unrealized capital gains. So for example, if you had $6 million of property, you paid $4 million for it, that $2 million of gain is going to be deemed to be recognized, and you would pay capital gains tax on that. Now, there is an exclusion for the first million, so you would really only pay tax on the million, but that is a drastic change in the way things have historically treated, in that usually you would get that gain just simply excluded and you would get a step up in basis to the 6 million. Well, now you're going to have to pay tax to get your step up in basis. There's also going to be a prevention to try to avoid this by shifting assets during lifetime. So instead of having $1 million like you get on your death, you only have $100,000 during your lifetime to exclude gains. So if I made a gift of property, I could exclude the first $100,000 of gain, but anything over that would be subject to capital gains tax as if I sold it to a third party. There are some exceptions for transfers to spouses, to charity, to charitable remainder trusts, other types of charitable trusts, which are going to be very important for reasons we can explain in a few slides. Qualified disability trust and cemetery trust, which are, I guess, also a type of charity in a way. And again, this applies to transfers made after December 31st, 2020, which could be a potential issue here, especially when we get into this treatment of trust. So if you contribute assets to a grant or trust, that's not going to be an issue unless that trust is outside of your estate. So if you set up a revocable trust, that's a grant or trust, and contribute assets to that trust, that's not going to be a deemed recognition event requiring capital gains taxes to be paid. That's just going to be simply a transfer to the trust, carryover basis, no issues. But if this is one of the defective grant or trusts that we use for estate tax planning, and you contribute assets to that trust, they're deemed to be sold, and you're required to pay income taxes and capital gains taxes as if you sold the asset to a third party. after taking into account that $100,000 exclusion. So with
So,
the, go ahead,
so
Alan.
let's slow down here a little bit, and let's just walk through this through. So I have a $10 million asset that cost me $1 million. And right now, when I die, they'll be able to sell it for $10 million and no tax. Under these new rules, they'll be able to sell it for, after I die, they'll be able to sell it for $10, and they'll pay tax on $8 million because of that $1 million allowance. Now, when they passed a law similar to this about 10 years ago, I think there was a $3.1 million allowance. So that's probably something that's going to be argued about. So once this law passes, if I want to get around it, I could give this stock to my daughter. But then at the moment I give it to my daughter, it's considered to be sold, except for $100,000 worth. So, and this is almost identical to the Canadian system. The Canadian system has been like this for decades. You can't even transfer stock from yourself to your revocable trust in Canada without triggering this game. So I would say one thing to get prepared for this law is to review your estate planning documents and your estate planning entities and make sure that these assets that you own are exactly where they should be. Quite honestly, for most of you who would send us your information, we would find that you have beautiful trusts and beautiful LLCs that own the wrong things. So you want to definitely make sure, why do I own a certain thing? Why does my wife own a certain thing? Why does a joint trust own a certain thing? That could become very, very important. But my next consideration, Brandon, is, as you know, I want to take my 10 million of investments, put it in an LLC, and sell it to a SLAT for a $6.5 million note. And I know today I wouldn't pay any income tax to do that. There's a risk that that could cause an income tax under this bill.
Yeah, under this Van Hollen proposal, since it is effective for any transfers made after December 31st, 2020, that would be a deemed recognition event under the bill and cause income taxes to apply on that transaction. Now, I think that's a little extreme, retroactive in effect to tax transfers like that, but that is the way it's proposed currently. Now, the House proposal would not be in effect till 2022, so under the House bill, that would not cause tax to apply.
Okay, what if my basis in the investments was 6,666,000 or more? Then I wouldn't have an income tax.
Right.
So I could do this with higher basis assets. And so clients where they have higher basis assets and lower basis assets, they would want to do this with the higher basis assets. Okay, so what about something that a client named Tom, who quite honestly knows more about this than we do now, says, well, because of that risk, or because of the risk that they'll close the exemption down lower after I make my gift, and I don't want to pay gift tax, I'll put it in a trust for my children where the trustee has the ability to disclaim it back. Using the law of disclaimer, which says if you give something to somebody and they disclaim it, then typically it follows the document, and the document can say, if I give this to Brandon and Brandon disclaims it within 9 months of receipt, I get it back, and then the tax law recognizes that it never happened. So is that feasible, Brandon?
Yeah, I think, particularly now that we have this potential tax that would apply on the transfer, then there are some fiduciary issues with the disclaimer like that, where the trustee would disclaim, is he violating the fiduciary duty to the beneficiaries by disclaiming the property and sending it back to the grantor that gave him the property? Potentially, but when you have this and you take this into effect, that transfer would cause capital gains tax to apply and decrease the value of the property that would be passing to the beneficiaries, then it might be in the best interest of the beneficiaries to execute the disclaimer. So I think this gives us comfort to use that type of disclaimer planning to plan for this. If this bill does go retroactive, we could undo the transaction by doing the trustee disclaimer. Now, you could also have the beneficiaries disclaim. You want to make sure if you are having a beneficiary disclaim that they are the sole beneficiary of the trust, so they can disclaim all the interest, or have limited remainder beneficiaries that would also disclaim their interest, so that every part of the trust would go back to the grantor, not just the actual income beneficiaries' interest, and the remainder interest would stay in the trust if you didn't draft that properly. So you want to plan for this. Make sure you're drafting in your documents the ability to potentially undo transactions if this tax would go retroactive and cause capital gains tax to apply.
I think the best bet for most families is just get your installment sale done, because I think the chances of this going back to being retroactive before it comes out of the House Ways and Means Committee is less than 1%. And even once it comes out of the House Ways and Means Committee, then you'll know to stop and not do it, or to take your chances. And it may never come out of the House Ways and Means Committee. We just are not going to know. What do you have for us next, Brandon?
Yeah, so just a little example. Let's say both of these bills did pass. What are we looking at for an effective rate for an estate tax? And so just a simple example of a $20 million estate. They have $10 million of built-in capital gains, so appreciation on the property in the estate. So taking into account the $1 million exclusion, you'd have $900,000 of gains to pay tax on at roughly 40%. Remember, because the capital gains rate now is going to be 39.6%, not the 20% that everyone's used to. So 40% rate would apply, so 3.6 million there. The taxable estate, you would get a deduction for that income taxes associated with it, whether that comes through like a income in respect of decedent deduction through 691, or an estate tax deduction under 2053. That's some technical language there for the advisors on the call. We don't really know that yet, but you will get a deduction in some way. So you reduce the estate by the income tax paid, you reduce the estate by the exclusion amount of the 7 million, assuming this is a married couple, and then you have a taxable estate of 9.4. So 40% rate, 3.7 roughly of estate taxes, total taxes paid $7.36 million of estate taxes, the net estate going to the beneficiaries, little over 12.5 million. So an effective rate overall, that's 36.8% effective rate. If you look at just the taxable part of this, so just the roughly 13 million there that's taxable, or the 9 million that's taxable, that's 56% effective tax rate that's going to apply to this. So drastically increasing what happens on death. There are going to be payment plans that you can spread this out over a number of years if it's something that's not liquid. If you have marketable securities, maybe it's not that big of a deal to liquidate everything, since you're going to have fair market value basis and pay the tax. But if you have real estate holdings, you don't want to have to sell your real estate to pay the estate and capital gains tax. So there are going to be payment type plans that would spread this out over a number of years, but it is pretty big change here, and pretty impactful in a way.
And if you're on the fence as to how much life insurance you should have on you, your spouse, or a second to die life insurance policy, guess what? It's gone up. Life insurance has always been well treated by Congress, and because Congress has always been well treated by the life insurance industry. So while we are not active advocates of second to die life insurance policies to pay death taxes, for some families, if we're not going to be able to move assets around like we used to, and we're not able to do these amazing installment sales based upon discounted values for low interest notes, then loaning money to a life insurance trust using split dollar, as I mentioned earlier, may be a good remedy, or at least a good insurance policy for this tax. And also, something that you should be aware of is look at your financial statement, talk to your advisors, and ask if you will qualify for an automatic 14-year payment plan under Internal Revenue Code Section 6661, which usually requires that 35% or more of your business company, that your business company is 35% or more of your estate. And if you have real estate, you want to be active in managing the real estate, not passive, so that that can be considered a business asset that you can get this payment plan on. But I like to walk through that scenario with families. You know, if we don't do any planning, that's fine. Mom dies, dad dies. How much do the kids owe? Where are they going to get it from? What do mom and dad suggest that they should sell first? What do they suggest that they should sell second? And then, well, maybe it's better to go ahead and do some of this planning, even though there's a very small risk that retroactive legislation could cause it to not work. Should we go to charitable remainder trusts?
Sure. Yeah, we can talk briefly about those. You know, here on slide 22, we have some just planning strategies from a Lineberg webinar that we tuned into that talked through most of this and had a really good discussion of the considerations that you can do to try to plan for this. You know, one of the interesting things I think that was discussed. Al, if you want to flip to slide 67, we can go to the charitable remainder trust. We'll talk a little bit about this while you're flipping, but should you consider, you know, selling capital gain assets today while the rate's still 20%? Should you consider deferring losses so you can offset those against a higher rate bracket next year? How do we spread out income? Maybe we recognize, you know, $900,000 of gain in December 31st, and then another $900,000 of gains on January 1, so we don't cross that $1 million threshold to have the increased capital gain rate apply. So there's going to be some playing games here to spread out income. Maybe you use multiple trusts. Maybe you gift to younger generations to have the gain not cross $1 million for any one particular individual. We'll just have to see what type of limitations they place and how they prevent us from playing those games, and then figure out where we can go and how we can plan to try to minimize those taxes. But one thing that is clear under the bill, and they specifically have allowed this by providing that a transfer to a charitable remainder trust is not going to be a deemed inclusion event that would cause those capital gains taxes to apply. So the benefit of that is when you have a charitable remainder trust and an asset is sold, there's no gain at that point in time. All the assets are still held in the charitable remainder trust. It has income beneficiaries, so it pays out a percentage of income, a stated dollar amount, maybe just the greater of fiduciary accounting income or the stated percentage. There's different ways you can draft the charitable remainder trust, but the benefit is no tax when an asset is sold, and then you can pay it out over multiple years. So you can spread out that income over, say, 20 years to make sure you don't cross the $1 million threshold and have the higher capital gains rate apply. The way it's structured is after the end of the stated term, whatever's left goes to a charity. So you have to have some sort of charitable inclination and charitable planning to do a charitable remainder trust. But if you do have that inclination and you do give to charity, then the use of a charitable remainder trust can be very beneficial here for this type of planning. And I think they'll get very, very popular if we do have any type of increase in the capital gains rate or any type of deemed inclusion on a transfer, because you could use these types of trusts to spread out that income over a number of years and then avoid recognition events when we transfer to a charitable type trust.
Right. So if you use what we call a flip NIMCRUT, you transfer the asset that you were otherwise going to sell to the flip NIMCRUT. You can be the trustee of the flip NIMCRUT. And the flip NIMCRUT could owe you 11% of the total value of the NIMCRUT assets every year for 20 years. And if there's anything in the NIMCRUT at the end of the 20th year, that can go to the family foundation, which you can then control, and that foundation can pay your family arm's length amounts to do charitable things. So, my gosh, if I can avoid a 40% capital gains tax plus a 3.8% Medicare tax by putting my stock in a charitable remainder trust, and then I don't have to take a penny out for the next 15 years, but then I can wait until the tax rates go down back to 15% or 20%, and they will. The pendulum always swings in this country. Take them out and pay taxes at that lower rate. Who the heck cares if 8 or 9% of the whole picture ends up going to my family foundation? It's more than worth it with that type of a swing. So if you've got a liquidity event coming up, besides throwing a big party and inviting us to it, you should consider putting some of your stock into a flip NIMCRUT. The charity will end up getting 6 to 8%. It could be your alma mater, it could be your favorite hospital, or it could be your children. And you can pretty much freely invest the assets of the NIMCRUT in stocks and bonds. And it's not all that complicated once you understand.
Yeah, very good point, Alan. And you think you made a good point too, is all this could be undone in 4 years. So don't freak out and sell everything you got today because you want to take advantage of the 20% rate before it goes to 40. It may go to 40, it may not go to 40. It may go to 40 for 2 years and then come back down to 20 or 15 or 10, who really knows? So I think in the use of something like the NIMCRUT, where you can defer the tax and then wait and see what happens, and then distribute assets and they become taxable when they're distributed, is a really important way to plan and help provide flexibility in the event that something were to change. We can make decisions as to when assets are going to become taxable and recognized for tax purposes by using something like a charitable remainder trust.
Can we go to page 98? Okay, page 98.
Yeah.
Oop, not the same 98. I was looking for 199A. There we go.
Okay.
It's this page 98, also known as page 104. Okay. Give some thought to putting part of your business into a trust that will be taxed to your child or grandchild. You're going to be in a higher bracket. Chances are, if you're watching this, or your high income clients are going to be in higher brackets. And the 20% section 199A deduction that's available to qualified business income is not going to be available to high income taxpayers. But if you have children or grandchildren who are below these thresholds, if married, if single, 163,003 for last year, if married, 326,600, you can put part of your business or part of a management company that manages your business into a trust that benefits your spouse, children, family, but is considered to be owned by just one of those children. It's called a Section 678 trust. So when your bracket goes up to 43.8 and that child's bracket is at 25, go ahead and let it get taxed at the child's bracket. The 678 trust receives the income. It reimburses the child for the child's income tax, but then it sits in the trust for your spouse and other children. So you can do this with medical practices and otherwise. So Brandon, I think this pretty much sums up the 40 minutes that we expected to spend on this. And we appreciate the fact that all of you who started with us are still on here. I wanted to go ahead and do another 10 minutes on creditor protection because it's such an important topic. We do a lot of this work in the creditor protection area, and quite frankly, the economy is doing great for most everybody, but it's buckling here and there. And especially now, look at contractors can't get materials. Everything's going great, except you can't get materials. So what is that going to mean in the long run? So Brandon, before I switch to creditor protection, do you have any last words on the tax end?
Yeah, I think it's hard to tell what's going to happen, but I think we need to be aware of it and at least give it some considerations and decide what you want to do, what you're comfortable with, what risk tolerance you're comfortable with, and then make decisions. But I don't think it can be ignored, but I don't think we need to take it as the Bible so far, because it could not pass. It's just really unclear at this point, so we'll have to wait and see, and hopefully we'll come out on the good side of it.
Yeah, we've seen many families go to $300 to $400 million net worths and then just lose 40% of it right there on death of grandpa because nobody did anything. And that, if you fail to plan, you plan to fail. So that's the end of our webinar. But here's the bonus, because I just wanted to go over this. I spoke at a national program Wednesday, and I talked about the biggest mistakes that estate planning lawyers and estate planners make with respect to creditor protection. And most of the people on this webinar are estate planning lawyers. So I just wanted to share this with you. It might be interesting. Number one, not aggressively analyzing and advising clients with what's going to happen if there's a catastrophe. In other words, for all of our clients, we have a chart, and most of you have seen our charts. And we can go through that chart with the client and say, you know what, if you get in an awful car accident or a child eats one of your widgets and you get sued for $1 bazillion, here's what you can lose and here's what you can keep. And here's what we can do so that you would lose less and keep more. The second big mistake is when clients get into these issues, don't try to do this on your own. You need to get a bankruptcy litigation lawyer who really, really knows her stuff. And there's a lot of bankruptcy lawyers out there who just do routine Chapter 7s, and they don't have to know nearly as much as a bankruptcy lawyer who has to do complex Chapter 11 work. So when you get help from somebody who knows what they're doing. Third, make sure you know what the rules are, and the rules can be very, very confusing. For example, the talk I recently gave was in Michigan. Michigan recognizes tenancy by the entireties as a creditor protection way of owning assets for real estate, but not for limited liability companies. But there was a recent Iowa Supreme Court decision which said if you form an LLC in Iowa, we don't care where you live, when you get sued, Iowa law is going to apply to determine the rules of your LLC. And that court allowed Iowa law to apply to give this couple charging order protection, which means a creditor could not reach into the LLC, but denied them tenancy by the entireties protection, which means the creditor was able to get the charging order. So I said, if you're practicing law in Michigan and a client wants to set up an LLC to hold investments, set it up in Delaware or Florida or Wyoming. They have tenancy by the entirety statutes. And based upon this Iowa Supreme Court case, if somebody sues one of your clients and they have a TBE ownership in a Wyoming LLC, you can at least argue that that is completely safe. And if they dive into bankruptcy, the bankruptcy code itself says that tenancy by the entirety's assets are protected. So, we see a lot of LLCs that are formed by accountants, which shouldn't be doing that stuff, or by clients themselves. Yes, you go to your Secretary of State website and you form it and you feel so smart. But if you don't have an operating agreement that gives you tenancy by the entirety's protection, that gives you protection from charging orders so a creditor would not be able to reach into the LLC, you need to have those looked at. You need to have them properly drafted. And for heaven's sake, if it's supposed to be taxed as an S corp, that LLC operating agreement better be properly drafted. So number 4 is more of the above. Number 5, we have the attorney-client privilege when we are able to talk to clients about their situation. And nobody, including the federal government, is able to see what we exchange with a client in writing. But there is an exception, and that is called the crime fraud exception. And if I'm helping a client commit fraud, or I'm helping a client commit a crime, then my files can be looked at. If a client makes a transfer of her assets for the purpose of avoiding a creditor, that may meet the definition of a fraudulent transfer under state law. And if it does, then Judge Sotomayor's decision in a U.S. Supreme Court bankruptcy case said that my files can be looked at by the creditor. So be careful what you put in your files. Secondly, be very careful of communications with CPAs. CPAs have confidentiality, privilege in state law under most states, but not at all in the bankruptcy code. So the lawyer needs to hire the CPA before the CPA communicates anything relating to insolvency or anything that's going to be involved with a bankruptcy. Sometimes people do need to dive into bankruptcy. If you dive into bankruptcy within a year of making a transfer that was made to avoid a creditor, then you lose your right to get a discharge forever. That creditor has the 20-year statute of limitations and may have a lien against your assets. So when clients get into trouble, find out who they're supporting. You know, oh, you're sending $20 a month to your mother-in-law in India. Stop sending the $20 a month to your mother-in-law in India. Go ahead and send her 10,000, and then we'll wait a year before we bankrupt. And maybe that 10,000 will be set aside in bankruptcy, but I don't want to lose your ability to get a discharge in bankruptcy. Making sure there's plenty of liability insurance. I hope everyone on this call knows that you have a $5 million or more umbrella liability insurance policy. If somebody uses your car, you can assume that you are responsible for what happens in that car. I have had many clients write many large checks, including a $10 million check that I recall, because they loaned their cars to other people. Don't put your car in your most valuable company. Put your car in somebody else's company. And when your children are learning to drive, let them drive grandma's car, assuming you don't like grandma. Or put the car in the name of the oldest child. Now, 7B, really important, easy to do. Nobody does it. Everyone's so proud that you have no debt in your company. You got a $10 million shopping center. You're so proud there's no debt on that property. Somebody gets in a gunfight in the parking lot, and you get sued because the lighting wasn't good enough and you knew the bar was a crazy bar. Don't you wish you had a $9 million lien against that property so that the first $9 million from the forced sale by the creditor would go to you? And so that the plaintiff lawyer would settle based on your limits of liability plus maybe $1 million? So put friendly debt against your assets. There are ways to do this tax-free. We do it all the time. It's got a cool name. It's called equity stripping. But there is a absolute right in the United States of America to have debt owed to the shareholder by the company secured by the assets of the company. I can't tell you how often I see situations where I just wish that had been put into place earlier. C, move your intellectual property out of the entity. You make widgets. Only you know how to make widgets. Yeah, the creditors may get the widget factory. They may get the molds. They may get the inventory, but they're not going to get they're not going to get to make any new widgets. Get your intellectual property out of the business. And then when all else fails, how more self-serving can I be than to say to move to Florida and get a big homestead? Because our Florida homestead protection constitution trumps our fraudulent transfer statute, which is why O.J. Simpson lives here very comfortably. Bowie Kuhn came here. Burt Reynolds came here. You just get your homestead, move in, even though you have a judgment against it. Unless you put dirty money in the homestead, creditors cannot touch it. When there's no hope and you have a huge creditor, make a pro rata contribution to an LLC. Get your friend to make a contribution. You make a contribution. There's no transfer between the two of you. Now you may have charging order protection. So often people come to me and say, well, I've got a jury trial in 3 weeks, and I was told that there's nothing I could do. And you know, what we can do in those 3 weeks can be very, very helpful. But if we had 3 months or 3 years, it would have been quite a bit better. So for a lot of clients, we take the existing company, Smith Store Inc., and we put a parent company over it. It's a tax-free, there's a tax-free way to do that. And then we have the operating company owe a promissory note secured by the assets of the company. The note is owed to Smith Holdings, Inc. And Smith Holdings, Inc. can have most of the money and could own some of the, could own the liquor license, could own some of the buy-sell agreement, so that the debt, the lawsuit is against Smith Store, Inc. The lawsuit is not against the holding company, but the Store, Inc. owes a big note to the holding company. Or you could do it as a new parent F reorganization, and you have your existing medical practice here. It sets up a new company that owns the medical practice. The medical practice keeps its name, keeps its tax ID number, keeps its Medicare identity. Hardly anyone knows this happened, but now it can make a tax-free transfer of its equipment and its real estate to brother sister companies, and it can owe a big note to the parent company. Now you get your malpractice judgment against the medical company. Sorry, not much here. Shouldn't you settle for the limits of liability? So maybe next week we can do more on some of these interesting topics. I think, Brandon, we've probably done enough for today. I see almost everybody's on, which means they probably fell asleep and were not able to stay awake for the presentation. We do welcome all your questions, comments, and suggestions. We'll probably be on next Saturday at 11 if our wives permit it. I want to thank our wives sincerely for letting us do this every single Saturday, but it's been a lot of fun. And quite candidly, the audience that we have, those of you out there, have been very supportive, and you've shown us that what we're doing here is helping a lot of people. So I hope that you can take some of this knowledge that we gave you and help not only yourself, but other people. You'll get the replay in about an hour. Please feel free to forward it to anyone you like, and especially to anyone you don't like, and have a fantastic rest of your Saturday. Thank you. How do I turn this off? I don't know how to. This is really boring, Alan. Could you do a better job next time? My gosh, you got a lot of trusts to draft now, and there's one in particular that the crummy power looks really crummy. So maybe Brandon can help you with that one. All right, bye-bye, everybody.